Make sure to claim your 2 free stocks with Webull. A credit spread or net credit spread is an option strategy that involves a purchase of one option and a sale of another option in the same class and expiration, but different strike prices. It is designed to make a profit when the spreads between the two options narrows. Investors receive a net credit for entering the position and want the spreads to narrow or expire for profit. In contrast, an investor would have to pay to enter a debit spread. Credit spreads are also versatile. Most traders are able to find a combination of contracts to take a bullish or bearish position on a stock by establishing either a credit put spread, which means a bullish position with more premium on the short put. Credit call spread, which means a bearish position with more premium on the short call. Let's use a put credit spread example. Stock XYZ is trading at $50 a share. So you sell 48 put for 50 cents. Buy 46 put for 20 cents. By doing this, the trade would create a net credit of 30 cents or $30. This is why the strategy is called a credit spread. If stock XYZ rallies, the put credit spread will decrease in value and result in a profit. Conversely, if XYZ sells off, the put credit spread will increase in value and result in a loss. As expiration nears, credit spreads will benefit from theta decay, unless they are completely in the money. Maximum profit and loss for credit spreads. Maximum profit for a credit spread equals premium received. Maximum loss for a credit spread equals width of strikes minus premium received. For the example trade above, the max profit is $30. The max loss is $170. A credit spread would be a complete losing trade if at expiration both legs of the spread expired in the money. If XYZ stays above your break-even point at expiration, then the put credit spread will be a full winner. Well, that's it for today's video. Don't forget to smash the like button and subscribe to our channel.